Hello, my name is Akshay Vaghela and I'm a Senior Associate here at WestBridge Tax.
Hello, my name is Tom Moore. I'm Director and Founder of WestBridge Group.
Welcome to Bridging the Gap, our series of podcasts on current topics in the world of taxation that we would like to introduce you to. In this episode, we'll be focusing on employee ownership trusts, more commonly known as EOTs. So, Tom, what are EOTs exactly?
Well, actually, an EOT is a special type of trust which is created for the benefit of employees of a company. It's an employee ownership trust. And these were introduced and going back many years really as part of a political drive to encourage wider share ownership within the economy. And that's a thread that you can see running through the agendas of various chancellors of different political colours. This has been something with which a lot of UK tax legislation has been keen to encourage through various arrangements. An EOT is the latest manifestation of that. And what it involves is a trust being created by a company for the benefit of its employees. How is that trust created? How does it get shares for the employees? It acquires them from one or more of the owners of the company. And there's a requirement that in order for a trust to enjoy some of the generous benefits that attach to it, that the one or more of the owners have to sell a stake that amounts to more than 50% of the shares in the company to the EOT. And this is thought of as being, this is the John Lewis model. This is the model whereby John Lewis had been able to incentivise the staff to make them feel like owners of the business and to act in a way that is very similar to being an owner of a business. And the vendor will usually receive some cash when they sell, and they'll also receive the promise of cash in the future in the form of a loan note or some other debt, something owing to them which will be paid off over time. And all of that will be paid for ultimately out of the profits of the company, whether accumulated at the outset or built up or accumulating in years after the sale takes place.
That's great, Tom. And just to sort of provide some facts and figures, there are more than 500 businesses that are employee-owned across the UK. It's something that's increasing in popularity. And as you quite rightly mentioned, John Lewis, who operate an EOT model, they're actually the largest operator of such a model in the UK with over 80,000 employed partners. Now, just going back to a point you made about how the consideration the vendor receives in relation to the sale of their shares to the EOT, you mentioned that part of it's funded in the form of debt owed to them. So it's key, and it's absolutely critical, in fact, that the company remains in a state to operate in a profitable way. So is the continuing involvement of that vendor, kind of critical to that?
It normally is, and it would be common for the person who's selling the shares in the company to continue to have some involvement in it. Ultimately, you're selling your shares to the company. It's a bit like a buyback of own shares, but with tax reliefs that are associated with it. And the tax reliefs are fantastic, by the way. Where you sell shares to an EOT, you're getting a 0% rate of tax, and it doesn't get any better than that. That's become a great attraction for people using an EOT because there is a relief that means that a sale of shares can qualify for a 10% tax relief. So this is business asset disposal relief, where it used to be entrepreneurs relief. But that's limited now to the first £1 million of lifetime gains that anybody makes. An EOT trumps that entirely because it gives you a 0% rate on a sale. But the question really about the involvement of the vendor following the sale, that's really important with regard to the ability of the company to fulfill its obligations on the sale. Remember, what will happen here is the vendor, the shareholder, will sell their shares to the trust. The trust doesn't have any money unless the company decides to put some money in it, which it does by way of a contribution. How does the company afford such a contribution? It does that by being profitable. Generally, the vendor will want to stay involved with the company to ensure that that profitability can be maintained and to ensure that nothing is done by the company that could seriously damage or impair its ability to make contributions to ultimately pay the shareholder, the departing shareholder, for the shares they've sold. Great.
You mentioned a point about the capital gains tax savings. That's a really big point here. And I think when we talk about what that could look like for a vendor, you mentioned the first £1 million of gains potentially being charged at 10%, any balance above that at 20% on a sale.
That's right.
So we're really looking at hundreds of thousands potentially
That's right. I mean, you can be, so, if you're selling a company for, let's go with 5 million, normally 4 million of that would be taxed at 20% and 1 million of that would be taxed at 10%. You're removing the entirety of that tax charge. So if my maths is correct, you're saving £900,000 in tax on that sale to the EOT. So the tax incentive for the use of EOTs is very strong. There's probably a bigger, is it bigger? It will be bigger in some instances. There's certainly a very big practical benefit for the vendor in selling to an EOT, and that is that you don't have to go looking for a buyer. It can be very hard to find a buyer. Lots of people assume they will find a buyer for their business, but generally business owners will exaggerate both the breadth of the market that exists for their shares being sold and the generosity and appetite of that market as well. So they may find a buyer, but not somebody who's willing to pay the price that they want. They may struggle to find a buyer at all. With an EOT, you can set your own terms. Now, that has to be based on a valuation of the shares that is justifiable, but subject to that, you can effectively agree any sale that you want with the EOT. And of course, that's as friendly a buyer as you can get, isn't it? It's somebody that is going to be happy to accept what you're saying at face value, and not a party that's going to impose some terms that are going to be unpalatable. So generally, in practical terms, the sale to the EOT is going to be a much more pleasant experience than a third-party trade sale might be.
Talking about the sale itself, obviously it has to be a controlling interest, which means 51%, let's say. So with the 49% that's left, can they retain that interest?
They can, yeah, and as you quite rightly say, it's got to be more than 50%. And the thinking here really is that the generosity of the tax relief is such that the government want to restrict this to situations where somebody really is kind of giving up their business ultimately in commercial terms. But the vendor can retain 49%. That means they can benefit from, let's say, a future trade sale. If a very good trade sale comes along and they still want to sell that 49%, it's there to be sold. In the meantime, the voting rights attaching to those shares may be important in blocking some of the more egregious things that might otherwise happen. And of course, the ability to take dividends on those shares maintains as well. So it's generally quite an attractive proposition to be able to get the superb tax advantages and create your own buyer in respect of more than half of your shares, while at the same time being able to retain the rest. That's
just great, isn't it? And I mean, what's HMRC's views on EOTs? Can you apply for clearance or have some sort of security from them?
Well, that's a really good question, because sometimes when we're speaking to clients about this, if they're not familiar with it, they can assume that this must be some sort of schemy or difficult or aggressive kind of thing. And these are well understood by HMRC. They are encouraged by HMRC. It's part of something that the government wants to happen. And it is possible to apply to HMRC to ensure that certain anti-avoidance rules that they can otherwise apply won't apply. And the rules I've got in mind in particular are the ones called the transactions in securities rules. Remember, what's happening here is you are selling your shares and the money you're receiving is really coming from the profits of the company. That might be existing accumulated profit. It might be future profit that arises in the company. One way or another, it is profit in the company that you're receiving. Now, normally, HMRC will take the view, shouldn't that really be taxed as a dividend that you're receiving? Isn't that some form of distribution? And the special transactions in securities rules allow them to apply exactly that kind of taxation. You can write to HMRC in the case of an EOT and other transactions, in fact, and ask for clearance in advance that HMRC will confirm that they will not apply those rules to that transaction. In the case of an EOT, where that's being used within the statutory rules that apply to an EOT, that clearance is pretty much a given. It's going to be very, very unlikely that HMRC would deny clearance. So yeah, you can be sure in using an EOT that provided you stick to the rules literally, there will be no chance of HMRC objecting to its use or applying any other kind of rules that could penalise you.
I mean, that's great. And a clearance that reduces any possibility of, an investigation into a transaction, for example, to pursue an income tax charge. That's the sort of additional layer of security that vendors really want when they're selling their business. So moving on from benefits for the business owners, let's talk about the employees.
Okay, the employees clearly have benefits as well, don't they? The employees are the beneficiaries of the trust. From their perspective, there is now a pool of shares that are being held for their benefit. That is intended and will, in most cases, give them the feeling of being owners of the business. They will have a stake in the business. They will have some skin in the game to some extent. This can be a hugely incentivizing factor for employees. So it can create a win-win. It can make the employees much more motivated, much happier in their roles, much more likely to be successful in their roles, much more likely to grow as individuals. It can be great from the business point of view because a business with those kind of people in it, with that level of motivation, is always going to work better. The rules do allow employees to receive a small amount of income every year, completely tax-free, so £3,600 of income that can be paid out to employees, but a relatively small amount, but obviously any tax-free amount is welcome, and over the years that will add up, and over a large employee base that adds up to a lot. So they're the benefits really from the point of view of the employees. It's not all plain sailing for the employees. It depends very much on who they are as people and what their attitude is to the workplace and to business generally. If you have very motivated, driven employees, very ambitious employees, ones willing to take a risk, ones that might form a team to undertake a management buyout, for them, an employee ownership trust and EOT might not be ideal because although the shares are there for their benefit, having the big payday that is normally the big incentive for somebody undertaking a management buyout, that exit when the company is eventually sold and money comes to you as a shareholder, that may be harder to engineer where we have an EOT in place. So it isn't a given that an EOT will be right in every circumstance. In a situation where there is a driven management buyout team, that will actually be a better outcome. And we often say to clients that if you can build a culture within your organisation and build an ethos that allows you to develop that cadre of people who are driven, skilled, experienced, knowledgeable, wanting the business to succeed, that's the kind of thing that can push businesses onto completely new heights and can really drive success. And that is likely to be a better option where it can be done than the use of an EOT. In other circumstances, commonly with businesses with a large employee base, not many of whom will be natural entrepreneurs, an EOT really comes into its own.
That's brilliant. And I think just to sort of summarise what we talked about on employees, you've got benefits for the employees immediately, which is having a slice of the pie.
Yeah.
The tax-free bonuses, which, depending on your seniority, your pay rate can be really attractive or not so. But nonetheless, if you compound them over a certain period of time, for example, £3,600 in bonuses for 5 years, for example, that's almost close to £20,000 in tax-free bonuses. So it's all about perspective.
Yeah.
But I think the point that you were trying to make there is that an EOT is pretty good in most scenarios, except from where it might not be able to satisfy the ambitions of a group of strong senior managers who are hoping for a lucrative exit.
I think that's entirely right. And turn that the other way around. If you are a business owner and you happen to know that there is such a team of people, and a team of people who are willing perhaps to take a bit of a risk, who are able to satisfy a lender that they're the people to drive the business forward, well, that might produce almost as good a result for you as a vendor, as an owner, a business owner wanting to sell, as the EOT does. Not quite as good a capital gains tax position, but it would still do a lot of the things that you'd otherwise want. That will often be the better way, taking everything into account. But that may be outweighed in some cases by the tax advantages that the EOT offers, certainly now with restricted business asset disposal relief. When entrepreneurs relief covered 10 million of gain, less of an incentive to get down from 10% to naught. a more obvious incentive to get down from 20% to 0. So there'll be circumstances when business owners will be attracted to an EOT anyway, even where they have a strong team of managers who might undertake an MBO. My general advice to people would be that if you can make that MBO happen, that's probably going to be, in the longer term, the better outcome for everybody. But an EOT, at the very least, provides an excellent alternative where you're not quite sure that's going to happen.
Absolutely. Well, thank you for your time today, Tom. That brings us to the end of our discussion on EOTs. We hope that you found it useful, informative, and we'd love you to join us for the next in our series on management buyouts.
I look forward to that, Akshay, and thank you for that. And if anybody does have any queries or any questions they have for anybody here, then please contact anybody at the WestBridge team.
Thank you.